Did you know that 60% of Americans don't have $1,000 saved for emergencies? This staggering statistic only scratches the surface of widespread financial misconceptions. It's a shocking reality that underscores the alarming lack of financial literacy in society. We live in a world where myths and misunderstandings about personal finance run rampant. They're in our schools, our workplaces, even around our dinner tables. They're handed down from generation to generation, often unchallenged, shaping our attitudes towards money and our financial decisions. These myths can hinder our financial growth and stability, leaving us vulnerable in times of crisis. They can keep us from reaching our full financial potential, from achieving our dreams, but it doesn't have to be this way. By debunking these myths, by separating fact from fiction, we can take control of our financial futures. With so many people struggling financially, it's time to separate fact from fiction. The first myth we're tackling is the notion of quick, easy wealth. It's an appealing concept, isn't it? The idea that riches can be yours with minimal effort, be it through a lottery win, a high-risk investment, or a get-rich-quick scheme. Sounds too good to be true? Well, that's because it usually is. Let's start with lottery wins. The odds of winning a major lottery jackpot are astronomically low. To put it in perspective, you're more likely to be struck by lightning twice than to win the lottery. Despite this, countless people pin their hopes on winning big, often spending money they can't afford to lose on tickets. Next up, high-risk investments. Now, don't get me wrong. Risk can be a vital part of any investment strategy. However, investments promising fast, high returns often come with equally high risks. You could strike it rich, sure, but you could also lose everything. It's a bit like gambling, and it's certainly no way to build stable long-term wealth. And then, there are get-rich-quick schemes. These are often disguised as business opportunities or investment strategies promising huge returns in a short period. However, they usually rely on recruiting new participants to pay off earlier investors. This is a classic sign of a pyramid scheme, which is not only risky but also illegal in many jurisdictions. So, what's the alternative? Steady, long-term financial planning. It might not be as exciting as winning the lottery or striking it rich on a high-risk investment, but it's a far more reliable way to build wealth. Investing regularly in a diversified portfolio, saving a portion of your income, and living within your means. These are the foundations of financial stability and growth. In conclusion, the myth of instant wealth is just that, a myth. It's a seductive idea, but it's not grounded in reality. Real wealth building takes time, patience, and a good deal of discipline. So, quick money-making schemes, more often than not, they're just that, schemes. Next up is a myth that could be damaging your credit score. The belief that carrying a balance on your credit card improves your credit. Now let's untangle this web of misconception. This myth is rooted in a misunderstanding about credit utilization and its impact on your credit scores. Credit utilization is essentially the ratio of your outstanding credit card balances to your credit card limits. It's a key component of your credit scores, accounting for about 30% of them. However, contrary to popular belief, carrying a balance, especially a high one, doesn't necessarily improve your credit. It can, in fact, hurt your credit scores because it increases your credit utilization ratio. High credit utilization can signal to lenders that you're heavily reliant on credit and potentially at risk of default. So, where does this myth come from? Well, it's likely because using your credit card regularly and responsibly does help your credit. But here's the key distinction. Using your credit card doesn't mean you need to carry a balance. It means making purchases and then paying them off in full and on time. This shows lenders that you can handle credit responsibly, which can positively impact your credit scores. Now let's talk numbers. Ideally, you should aim to keep your credit utilization ratio below 30%. That means if you have a credit limit of $1,000, try not to carry a balance of more than $300. Even better? Aim for zero. Pay off your balance each month to avoid paying interest and to keep that credit utilization ratio as low as possible. So to debunk this myth, carrying a balance on your credit card doesn't improve your credit. Instead, what matters is the responsible use of your credit card, timely payments, and maintaining a low credit utilization ratio. Remember, your credit score is a reflection of your financial responsibility, and carrying a balance can be a costly mistake. Remember, carrying a balance isn't boosting your credit, it's costing you money. Many of us grew up hearing that renting is throwing money away and buying a home is the only smart choice. But is that really true? Let's dissect this homeownership myth. Homeownership is often equated with financial stability and success. It's a tangible representation of your hard work, a place to call your own, and let's not forget it's an investment that can appreciate over time, but it's not all sunshine and rainbows, folks. Owning a home comes with its own set of challenges. Maintenance costs, property taxes, and insurance can add up, and these are costs that renters don't have to worry about. Plus, there's the mortgage. A mortgage can tie up a significant chunk of your income for decades. And what about the down payment? It can take years to save up for that initial cost. On the other side of the coin, renting offers flexibility. You can move without the hassle of selling a house. You're not responsible for maintenance or repairs. And if you're investing the money you'd otherwise spend on a mortgage, you could potentially see significant financial growth. But let's not oversimplify. The decision between renting and buying is complex and highly personal. It depends on factors like your financial situation, your long-term plans, and even the housing market in your area. For example, in some cities, renting might be more expensive than a mortgage payment. In others, the opposite might be true. And then there's the question of whether you're ready to settle down in one place for a considerable amount of time. So, here's the truth. Homeownership is not a one-size-fits-all solution. It can be a great decision for some and not so great for others. It's essential to consider all the factors and make the decision that's right for you. In the end, the myth that renting is throwing money away and homeownership is the only smart choice is just that, a myth. It's not about whether renting or buying is universally better, it's about what's better for you, considering your personal and financial situation. So, renting or buying, it all depends on your personal financial situation. Our last myth for today is the idea of the self-made millionaire. This is a phrase we often hear, a concept that's been romanticized in books, movies, and inspirational talks. It's the classic rags to riches tale, the idea that anyone, regardless of their background, can pull themselves up by their bootstraps and become a millionaire with just hard work and determination. But how accurate is this? Well, let's unpack it. Success, especially on the scale of becoming a millionaire, isn't achieved in a vacuum. More often than not, it's the result of a combination of factors, many of which are beyond an individual's control. First up, privilege. It's an uncomfortable truth, but one's socioeconomic background plays a significant role in shaping their chances of financial success. This could be in the form of inherited wealth, access to quality education, or just being in the right place at the right time. Next, let's talk about luck. Yes, hard work is important, but so is being at the right place at the right time. Many self-made millionaires have stories of chance encounters, unexpected opportunities, or simple good fortune that played a pivotal role in their journey. Lastly, support. This could be from mentors who provide guidance, a supportive family, or a network of connections that can open doors. The idea of a lone wolf achieving success without any help is far from reality. The myth of the self-made millionaire can be harmful because it downplays these factors and promotes the idea that financial success is solely the result of personal effort. It can lead to self-blame and frustration when individuals, despite their best efforts, are unable to replicate the success stories they've heard. So is it possible to become a millionaire through hard work and determination alone? Yes, but it's not the norm. It's important to understand the role of privilege, luck, and support in these narratives. Remember, success is rarely a solo journey, and financial success is no exception. We've debunked some common personal finance myths today, but this is just the tip of the iceberg. We've shattered the illusion of instant wealth, reminding us all that wealth is a marathon, not a sprint. We've debunked the credit card myth, showcasing that credit cards, when used responsibly, can be a useful tool for building a good credit history. We've also burst the bubble of the homeownership myth, stressing that it's not always the best financial decision for everyone. And finally, we've dismantled the myth of the self-made millionaire, underlining the role of luck, timing, and help from others in achieving financial success. In this journey of separating fact from fiction, we've highlighted the importance of financial literacy and critical thinking. It's the armor that protects us from falling prey to misleading financial myths. So let's keep asking questions, keep learning, and keep debunking. Remember, knowledge is power, especially when it comes to personal finance. Stay curious, stay educated, and keep debunking those myths.